Welcome along to Property Tribes TV, where I'm joined by Stephen Johnson of Shawbrook Bank. So welcome, Stephen, and we're very pleased to talk to you today because there's some exciting news from Shawbrook, isn't there? Just tell us what's happening.
Hi, good afternoon, Vanessa. Hi. Yes, we're just about to launch some fixed rate products, anywhere from sort of 3 through to 5 year fixed periods for our long-term investors. So yeah, I would like to talk a little bit about that, and maybe just comment on kind of the interest rate environment and the outlook maybe for your investors. So that would be great if that's okay.
Of course. So what have been the triggers for Shawbrook to come up with these products?
I guess principally sort of investor demand, really. I think clearly more investors sort of read in the media and follow sort of commentary from sort of economists. Clearly we're entering a period of sort of near-term interest rate rises. A bit divided. People, some people would say early 15, some people would say late 14. So people are a little bit divided on that. But one thing everyone's agreed on is that we will be entering a period of rising interest rates from their historic lows. We've been nearly this historic low level for nearly 5 years. So we're going to come out of that period now, and I think investors should be very, very mindful of that. We have been, ever since we started lending, very cautious about, is it sustainable in the long term? And obviously the economics have been very favourable for landlords with strong rents and low interest costs, but those dynamics are going to change a little bit. So I think it's important that investors are alive to that.
Absolutely. What sort of features of the products? Could you give us a little insight into the kind of interest rates and any other features that make them attractive to landlords?
Sure. Well, we're going to be offering a 3-year, a 4-year and a 5-year option for clients. You can have that overlaid onto a longer term mortgage, and once the fixed period kind of expires, you can revert to a variable rate tracker rather than SVR, and we think that that's transparent and gives investors some confidence so they know that the rate that they'll fall back on will be an index tracker as opposed to kind of a managed rate by a bank, which I think is a little bit opaque. So that's key benefits. We're not charging any additional fees or booking costs, so we're providing a straight pass-through really of the cost of the future interest rate to the borrower without any additional fees. And again, we think that's a compelling offering. We're not discounting the rates. We are literally passing on the cost of sort of future interest rates to the borrower, and they can then make a decision based upon their sort of investment appetite and what they think is best for their needs, really, rather than offering deeply discounted rates which might tease an investor in. So that's our approach. When we look at the interest rate environment, I think a bit more broadly for investors, rate rises are coming. They are forecast to be gradual rather than sort of steep, because there's a few reasons. Principally, the inflation outlook looks pretty good. So we've got a good inflation environment. We've got a strong pound, and there are still risks of shocks, whether they be European or other sort of global crisis. Recently, obviously, the Ukrainian-Russian conflict is a good example of that. So I think for all those reasons, we're unlikely to see interest rate rises steeply. We're more likely to see them gradual. If you look forward 5 years on a LIBOR rate today, the 5-year swap is around 2.2% versus LIBOR currently of about 55 to 60 basis points. So you can see, if you look forward that environment, then the markets are anticipating rates going up 1.6, 1.7%. And I think what the markets are also suggesting is that kind of the new normal interest rate environment will be 3.5%, as opposed to sort of traditional normal 4 to 5. So the markets are saying that we're going to get up to that sort of 3.5% over the course of the next 3 or 4 years, but forward looking from there, they aren't anticipating much further interest rate rises, and that's sort of the look at the moment. So I think it's important that investors maybe appreciate that, because that can have a big impact clearly on the funding costs and their overall economics. Obviously, predicting interest rates is very, very inherently difficult, risky. It's not something that you'd probably encourage investors to do. And I guess I think a lot of them just like the certainty of the fixed rates. They haven't got to worry about that sort of stuff, and they can budget on day one, knowing full well for the term of that period they've got a good visibility on their free cash flow. And I think that would clearly what we're trying to offer is a transparent sort of offering where they can do just that and not have to worry necessarily about sort of the interest rate sort of movements on, and how that might affect their debt costs.
Would you say these products are for any specific sort of type of landlord, or would they be suitable for anybody that feels that they want to go onto a fixed rate?
No, I mean, we believe that they'd be suitable for any. I think the key here is kind of choice and options for those landlords, and some landlords may be lowly geared, with plenty of rental surplus, and feel that they're happy to sort of not fix, and they've got enough sort of cash flow to sort of ride the rising interest rate environment. Others may feel they're slightly higher geared and would like to take some comfort and some certainty from fixing that rate. So ultimately it's the investor's choice depending upon their sort of investment profile. The one thing I would be cautious about for investors is taking sort of short-term fixed rates. I think they're unlikely to provide much protection, and by the time you roll out of that fixed rate, you're probably in a higher interest rate environment. So I think shorter dated fixed rates I would see is probably less attractive, but ultimately it's down to investors to make their own decisions really based upon their own outlook and taking a view on what they think is the right option for them.
No, I can see. I mean, I think that anybody thinking of fixing, they should be looking at the sort of 5-year fixed, really. As you say, if you're going to go to the trouble of fixing, then at least lock in that rate for 5 years, and things will become a lot clearer throughout that 5 years as to what interest rates are going to do, won't they?
Yeah, I think that's sensible. Certainly, sort of longer dated fixed periods, I think, make more sense, I think, when you look at the interest rate environment. But ultimately, that would be a question maybe to take advice from a financial advisor on. But yeah, that seems a more sensible place to be.
Now, consumers can't go direct to you at Shawbrook, so if they're interested in these products, they can just speak to their financial advisor and ask for them by name, can't they?
Yeah, sure. I mean, hopefully we've got a pretty strong brand with the intermediary community. We do obviously engage with our professional investor clients regularly, but our model is predicated on intermediaries presenting the cases, processing the paperwork for us. So we have a very very joined up approach with our intermediary. And we can clearly help investors find a good quality advisor in the market who can also give them choice, not just Shawbrook products, but there may be other solutions for them in the market. So they provide an important whole of market sort of role in terms of advice, and also take the time out of the process. Busy, should be out there looking for opportunities as opposed to working sort of finance paperwork. So they take some of the pain out of the process as well.
Fantastic. So just to finish, Stephen, somebody thinking of fixing, what would be the kind of top 3 questions they should be asking themselves? I think they should be looking at their overall cash flow from the property. So what kind of yield do they get from their portfolio? And if interest rates went up 1-2%, which they're likely to do in a sort of a forward 3-look environment, would they be able to sort of withstand that? So only look at the overall cash flow. I would look carefully at the terms of those mortgages. How long am I tied in? What would happen if I got an offer for a property and I had to sell or wanted to sell? What would be the cost associated with it? And then I guess thirdly, I would look at what happens when the fixed rate ends. What do I revert to? Do I revert to something that I understand, or am I reverting to kind of a managed rate where I might not really understand what the interest rate will be at that time, and therefore that might be a little bit unsettling. Okay, brilliant. Well, thanks so much, as always, Stephen, for sharing your insights. We've been talking about the new Shawbrook Bank fixed rate products. When do they become available, Stephen?
So we're hoping next week or the week after. We're just in final system testing.
Brilliant. Okay, well, thanks very much for joining us, and I'm sure this is going to sort of spark quite a debate amongst the Property Tribes community about whether now is the time to fix or not. So let the debate begin. Thanks very much, Stephen.